Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And today we're going to talk about tax considerations to think about if you're a mineral, royalty, or working interest owner. And we're talking about for tax year of 2023. This is 2024 when we're recording this. And Justin, we've covered this topic a couple of times, and most recently in 2022 in episode 146. And while many things have stayed the same, and we'll talk about those things, some things have changed or will be changing soon, potentially. And so we really wanted to provide an update on those tax planning considerations for mineral and royalty owners that might be affected by those upcoming changes.
You said it, Matt. And as with everything, it's ever evolving, and these tax considerations change as time goes on. And as you mentioned, Matt, we have some that are slated to change, though that could be modified depending on legislation.
Yeah, that's a good point. So that's always the caveat. This shouldn't be construed as tax or legal advice. So of course, you need to consult with your CPA and with your attorney if you have any questions specific to your situation. We're just sharing this for informational purposes only. But we do want to dive in and give you that information so you can have those informed conversations with your tax advisors to make sure that you're making the most of your minerals and royalties. And that's what we're going to cover today. And specifically, a lot of the deductions that are available that many mineral and royalty owners that maybe just inherited interest or have just started investing in this asset class that they may not be aware of. And so you want to make sure that your CPA has experience with other clients that have oil and gas assets, because there's some very specific things that you need to be doing to make sure you're taking advantage of those tax deductions. And also, if you have major events that have occurred in your life, you need to be proactive in determining what actions you need to take. And we'll talk about some of those events, and so you know what to be doing and what kind of questions to ask your CPA. And before we dive in, though, I want to just highlight, we do have a free resource guide that you can download that provides some additional resources that you can review to make sure that you're making the most of those allowable deductions, and so you don't let anything slip through the cracks in terms of what you should be claiming, or from a deduction standpoint or from an income standpoint. You can go to mineralrightspodcast.com/tax guide. So mineralrightspodcast.com/tax guide, or you can just look for the show notes for this episode and you can find the link there. So before we dive in, Justin, again, we're talking about tax season is around the corner. We need to be thinking about, as we're putting together all the documentation, all the things that happened last year. And a couple of questions you need to be thinking about, are related to major events. Do you want to cover what those things could be?
Sure, man. Yeah, you need to be thinking about, did you lease your mineral rights? Did you execute a lease with an operator for them to drill? Whether you've received proceeds from that or not, as far as royalty payments, there may be reporting that needs to happen with the actual leasing side and the bonus paid. Did you inherit mineral rights or royalties? This is one that you may not incur tax liability in that the year that you inherited them. But if you decide to sell them in the future, then knowing the value at the time of inheritance is needed to determine your tax liability when you sell them, Matt. And I think people can often be surprised when they sell mineral rights and they get to tax season, because the CPA is going to go, well, what was the step up in cost? And if you're not prepared for that answer, it's something you really have to quickly try to find somebody to determine for you. And then, did you sell all of your minerals or royalties last year? Did you sell part of them? And again, what was the step up in cost basis for that so that you can properly file your taxes now?
Yeah, that's a good point. That could be a huge benefit, especially if you recently inherited the interest and there is a lot of oil and gas activity. You could have a substantial amount of value that you could claim as the cost basis at the date of death or at the alternate valuation date. And all of that we cover in another episode. And again, we'll link in the show notes to some of those episodes about an IRS appraisal and what it takes to do that, and then how minerals and royalties are valued, because that's an important consideration. But speaking to your first point, Justin, what are the things that we need to be doing if we leased our minerals this year and we received an upfront bonus payment? And so do you want to talk about that whole process of leasing and some of the important considerations there?
Absolutely, ma'am. So typically when you're leasing it, you're receiving a paid up lease, and those lease bonus payments come with that paid up lease. So that paid up lease and that lease bonus is considered ordinary income, just as mineral royalty income as far as production checks are treated. And that's something that you have to report. And typically, Matt, if that's over $600, you're going to receive a 1099 form from the operator, whether that is a lease bonus or whether that is royalty payments. And that's something that you'll see in the tax season. Ordinary income is divided into any type of income that's taxed at ordinary rates, including but not limited to salary or wages from a job, bonuses, commissions, rents, and royalties. The tax rate you pay on ordinary income depends on how much income you received and your filing status. For example, if you're single, married, filing jointly. We won't cover in detail here, but most taxpayers have to look at more than one tax bracket to calculate your effective tax rate. In other words, if your income level falls into the 24% tax bracket, you pay taxes at the lower rates for the income that falls within the bracket. And then you have to add these up to determine your effective tax rate, Matt. And if you are a new mineral owner, if you inherited these mineral rights and you've been receiving production payments, it can be a surprise to people that first year when they file their taxes, because you will owe taxes on that income in a way that you don't necessarily if you're a W-2 employee.
Yeah, that's a good point. And the reason for that is because if you provide your tax ID number, the operator will not withhold income tax from the royalty payments. And so you need to be saving some of that money during the year because you're going to owe those taxes when you go to file your tax return. So they'll have to report your royalty income, and then that'll be added up with the rest of your ordinary income. And if you do receive a substantial amount of royalty payments, maybe a lot more than what you get from your W-2 job, then you probably should be making estimated tax payments throughout the year. And you need to get with your CPA to make sure that you're doing that so you're not hit with a penalty when you go to file your income taxes, because you're going to owe taxes on that royalty income and it is not typically deducted from your royalty check. So something to be aware of. And you'll see certain taxes on the royalty check, and we're not going to go into detail on that here today. We have an episode 97, where we go through how to audit your oil and gas royalty statements. And we talk about some of those things you'll see on that check statement and on the 1099. But like Justin said, ordinary income is the big thing to remember for lease bonus payments and for royalty payments. With oil and gas royalties, it's a passive type income coming from either your mineral royalty interest or an overriding royalty. And you don't bear the cost of operations or development except for those taxes, whether it's state severance taxes or state property taxes, and then any post-production costs that the operator can deduct from that. And so that's something you need to be very aware of, about making sure you're paying those estimated taxes if you need to. Again, get with your CPA for specifics on how to handle it and where to report that on your tax return. And this time of year, this is a good time to do a quick check on those 1099 statements that you receive from the operators to make sure that they're correct and actually reflect the amount that you received in that tax year in terms of the gross royalties showing up on your revenue statements. And again, in that episode 97, we walk through step by step on how to do that quick end of year audit so that when you go to file your tax return, you're reporting the correct amount to the IRS, and that the 1099 that the IRS has reflects that same correct amount, so that you don't have to, get into it with them about, well, no, they actually pay me this, but then, what they reported was wrong. You want to catch that before you file your taxes so that it doesn't cause you any headaches down the road. Okay, Justin. So we've talked about the bad side, right? The downside, which people get bent out of shape about having to pay taxes, but it's a kind of a nice thing that you're getting this extra income. And yeah, you have to pay taxes on it. But some things that royalty owners may not be aware of is there's some amazing tax deductions that we can take advantage of. So do you want to walk through some of those so that we know what kind of questions we can ask our CPAs when it comes to filing taxes?
Absolutely, Matt. I think the first thing is, much like if you have an LLC or you've done any other kind of business, you can keep all the receipts from the money you spend working on your minerals. So for example, if you hired an attorney to file some deeds, if you hired a landman to do research, consulting fees to get an idea of how to manage your minerals. All of this is deductible from your royalty income. You need to be sure you keep your receipts and you can show your accountant the expenses that were related to this. And Matt, one that is probably the most well-known is the depletion deduction. But at the same time, it is something that too many mineral owners don't take advantage of. And Matt, the depletion deduction is pretty significant and certainly something you shouldn't pass up.
Yeah, if you're getting royalty payment, now again, this depletion deduction is only deductible against your royalties. It can't be deducted against a lease bonus payment. So that's something to think about. It's only once oil and gas is actually sold. And the reason for the depletion deduction is it's a similar concept to depreciation of the cost of fixed assets. If you purchased an investment property, you get to deplete the cost of that property over time. And so this is a similar concept because what IRS calls oil and gas producing property, it's a wasting asset. In other words, it's a finite asset. And as you produce oil and gas and sell it, it is removed forever from the deposit and that deposit becomes depleted. And so that's where the depletion concept comes in. So you're able to deduct basically a deduction from the income for the depletion of the economic interest that you have in those oil and gas wells. And that can be from your mineral interest, royalty interest, or working interest. And so it comes from both the mineral estate and the leasehold side of things that you get to take into account this particular deduction. Now, you want to make sure that you do is you're recovering your cost basis in that investment, so to speak. And again, most of the royalty owners take what's called a percent depletion deduction. There's two ways that the depletion deduction can be computed. The first one is the percent depletion, which is generally calculated by multiplying your gross income from the oil and gas royalties by 15%. So in other words, you get to deduct 15% from your royalty income in that year with this particular IRS tax deduction. And there's one consideration there is that it's generally limited to the smaller of your 100% of your taxable income from the property or for 65% of taxable income from all sources, both figured without the depletion deduction. So there's some limit. You can't just deduct all of the income or whatever. You have to have some limits on how much potentially, but your CPA can work that out for you and make sure that you're getting the most there. And the other method that is used is the cost depletion method. And this is something that most royalty owners don't take advantage of because it actually requires a professional appraisal, because what the actual cost depletion does is it looks at the estimate of recoverable reserves of oil and gas from your wells that you're receiving the royalties from. And then you get to deduct the volume produced in that year times the cost basis. And that determines your basically the fraction of that total amount and what the total value was. And so you can look at that as a way to potentially write off the capitalized cost of a mineral property. And again, for people that invest in minerals and royalties, this is something you may have already if you had an appraisal, if you had a valuation done to determine how much you were going to pay for that property, and you had an engineer provide an estimate of what's called the estimated ultimate recovery, or EUR. And that's, again, the total oil, gas, and natural gas liquids that are in the ground that you'll potentially get over the life of those wells. And one of the things that a CPA that is a listener mentioned to me that was a good catch is if you actually inherited property in the year, when you take a step up in cost basis for that property, that actually can be a way that you can speed up, that cost depletion if possible, so that you're taking a percentage going forward, and your CPA can look at whether the cost depletion or the percent depletion is actually more beneficial from a tax deduction standpoint. And again, this probably only makes sense to do if you have a substantial size interest, because to get that appraisal, it's going to cost you a couple $1,000s to get that estimated ultimate recovery of oil and gas, to be able to calculate that cost depletion. But your CPA can tell you if this is actually going to be potentially worth looking at, and then you can switch potentially between the cost depletion to percent depletion depending on where you're at, because it does allow you to take either the greater of the cost depletion or the percent depletion. That gives you an option if you have that information available to calculate that. Okay, Justin. So we've talked about the percent depletion, cost depletion. So that's an important concept. And so make sure that your CPA is doing that when you're asking them questions, when you're talking about your end of year tax stuff. Because if you have a CPA that's not familiar with oil and gas taxation, then it might be something where it's worth educating them, and we can provide some of the resources we have available, again, in that free resource guide, or potentially maybe a time to find another CPA that does have that experience, because you want to make sure that you're taking advantage of those. So we talked primarily about the mineral and royalty side. Justin, you want to talk a little bit about some of the deductions that are available for working interest owners as well?
Sure. So working interest is a little bit different in the type of the interest that it is. A working interest is an ownership in oil and gas lease, also known as a leasehold interest, that provides the owner with the right to explore and produce oil and gas and other minerals. The working interest owner bears the proportional share of the cost of drilling, completing, and operating a well in return for their share of the oil and gas produced. You'll often know it's a working interest by having an executed authorization for expenditure or an AFE with the operator. And this will come with a letter that explains your option for you to elect whether or not to participate in the well and pay your proportional share of the cost to drill and complete the well, or whether you are going to go non-consent and not pay for the cost and not get your proportionate share of the revenue until the operator has recouped not only the cost, but a risk penalty for having to carry your share of the expenses. And Matt, working interest can get really complicated quite quickly. And this is something to certainly work with an attorney and a CPA on. But more information on the different types of oil and gas interest is something that, if you haven't learned about that, getting into Matt, for people who don't know what a working interest is and they have one, your mineral management course is a really great place to start to kind of lay the foundation on what are the different types and why are there different types of mineral rights. For tax considerations for working interest, there are actually benefits for owning a non-operated working interest, and this is something to really work with the CPA on. In the US, the IRS considers a working interest a non-passive activity, and as such, any losses associated with the interest may offset other ordinary income. Also, a working interest owner may be able to deduct other costs, such as intangible drilling cost or development cost in the year the expense is incurred. IDCs include expenses like the cost of drilling, completing that well. Tangible costs are things like casing and cement and the other physical components of the well. And Matt, this would be when you execute that AFE with the operator, this would be the kind of information that would be made known to you. And that would give you the ability to kind of file this on your taxes. But as you mentioned, Matt, this is less common and more so something where you're really in the business. And, typically you might have an LLC in this entity, or it just depends how you've gone about doing that.
Yeah, exactly. This is definitely the more sophisticated area as it comes to oil and gas investing. And certainly this is typically, like Justin said, something where you're in the oil and gas business, you're investing in these types of interests. Although I do say I have a few clients that have inherited non-operated working interests from an uncle, from a grandfather, that kind of a thing, that were in the business. And now they're having to deal with these types of situations and these considerations. And so, yeah, there's definitely a lot to think about as it relates to these types of oil and gas interests, because there's a lot more to consider, around liability, both environmental liability potentially and financial liability, because you're on the hook for your proportional share of those costs. Again, whether or not the well is profitable. So in the future, as that well depletes and the cost of operating the well exceeds the revenue that's generated, that you'll come time to have to pay your share of the cost to plug and abandon the well. And so that's all things to think about. And obviously you want to get with your attorney, get with your CPA to figure out the things you should be doing. But, like Justin said, the ability to expense the intangible drilling costs in the year they're incurred is a massive tax benefit. So if you spend money on investing in a working interest, then even if there is that cost, you have that tax benefit. And the whole reason for that originally, I believe, was to spur investment in oil and gas development, because the US, for most of the history of our country, was not energy independent. It was really only in the last years that this has become something that we've enjoyed. And so before that, they really wanted to encourage investment in domestic production from a national security standpoint. We had a lot of times with embargoes with Middle Eastern countries and things like that we were faced with shortfalls and of having enough oil and gas here in the US. And so they wanted to encourage investment. So that is what those originated from. So that's an important thing to think about. It's an important tax consideration. If you do have a working interest and you're presented with that opportunity, it does become something you have to think about, both the liability and all the considerations there, but then also the benefits that come with it. And then, like Justin said, I go into a lot more detail on the different types of oil and gas interests and how they all fit together in my Mineral Management Basics course, which you can find a link in the show notes, or you can go to mineralrightspodcast.com/courses to find out more about that.
Absolutely, man. And like we've alluded before, inheritance of mineral rights and royalties is something that is probably one of the most asked about topics, Matt, because you inherited these mineral rights. Maybe you began receiving checks. Maybe you haven't even began receiving checks, but there's all kinds of implications to filing your taxes, something to keep up with, and something to understand. And Matt, how many questions a year would you say you get about taxes when it comes to either inheriting or they sold the property after inheriting it? I'm sure it's one of your top.
It's definitely one of the top questions that I get asked. And actually, a lot of my clients, that's the kind of first interaction around, hey, I've inherited this property. I need to figure out what it's worth for tax purposes. We want to claim a step up in cost basis, that kind of a thing. And so, yeah, certainly one of the most common situations. And I think a lot of it is just because this is such a complex asset. And a lot of times our predecessors didn't take us under their wing early and educate us on inheriting this type of property and the things you need to know. And frankly, there's just so much to learn, and they may not know whether or not you're going to want to go into that, but they want you to benefit from this legacy that your family has enjoyed. So yeah, it's very common for people to be faced with, and I don't know the number of questions I get. I don't know the number of questions, but I think it's, certainly maybe one or two a week that people reach out about something related to inheriting minerals and royalties. So very common. And then don't worry if you're in this boat and you're trying to figure this out and if you feel like you're drinking from a fire hose. I think that everybody feels like that at the beginning. And I know, Justin, you've shared your story and a few of our other listeners have shared their story, but just know there's light at the end of the tunnel there.
Absolutely, Matt. There's good people out there to help educate you. And Matt, the services you provide are often surrounded around that. And then a good CPA is just worth their weight in gold if you're going through the situation. And Matt, most of the time, you don't have to pay taxes on inherited mineral rights royalties until you sell them. There was some noise last year about the possibility of charging tax on unrealized capital gains associated with the inheritance of property. But thankfully, that was taken out of proposed legislation. Matt, that would have been a huge change. A possible exception to this is estate taxes. And if you're lucky enough or unlucky, depending on how you look at it, to have to think about estate taxes because you're inheriting an estate with a value near the amount that would trigger an estate tax return, then it's something where it can really come up, and it's something that can often require you to go through a lot of steps and work with a CPA and a consultant to help you value your minerals. And Matt, do you want to talk about what the limits are currently? And then there's some coming changes to those limits that are on the horizon.
Yeah, that's a great point. So the current federal estate tax rates were put in place in 2017 as part of the Tax Cuts and Jobs Act. And those rates range from 18% to 40%. The tax exemption amount, so the value of the estate before you have to pay estate taxes, is $13.61 million per individual for 2023. And this is scheduled to sunset at the end of 2025. So those changes that were put in place with the Tax Cuts and Jobs Act were temporary in nature, and they're going to revert back to the pre-act levels, which is estimated at $7 million per individual when you adjust it for inflation. So it's going to be cut in half roughly when you think about where the current estate tax exemption is to where it will be after 2025. So if you have a large mineral and royalty portfolio, that could be more than that limit. Again, that's per individual. So if you have a married couple, you would double that. So that's a substantial amount of money, but there are some clients that I've helped in the past that had assets that were pretty close to that estate tax exemption amount. And, certainly with that dropping so substantially and with all of the oil and gas activity occurring in the US, if you have a big portfolio and now all of a sudden you're starting to get a lot of drilling occurring and things like that, the value of that could be pretty significant. And there may be things that you need to be thinking about around making moves now while that exemption amount is at the current level, so that your heirs don't get hit with a big estate tax bill when you pass. So that is something to think about, something to be aware of, and definitely something to get with your CPA about your options, because there might be some things you could be doing to minimize the chance of that affecting your heirs. The thing that to keep in mind depends on which party has the majority when this thing is scheduled to sunset, and if they look at passing legislation that will make it permanent or that will extend that limit at that higher amount. So that's a big uncertainty that's out there. Obviously, you'll need to get help with your CPA and your attorney to make sure that you're taking that into consideration. But that's the estate tax side. If you inherit the property, regardless of whether or not you decide to sell it or not, you may be on the hook for an estate tax bill. But let's say you do inherit those interests, Justin, and you decide to sell them. You want to talk about or the capital gains considerations when it comes to selling a mineral property.
Absolutely, Matt. And like you said, so the scenario of this would be that you inherited this mineral right property, and this is, you're thinking ahead to have the option to sell it in the future, or maybe you're thinking about selling it in the future. Generally, if the property has been owned for more than a year, the sale will be taxed as long-term capital gains. Similar to owning stock, you would take the sales price minus the cost basis to determine the tax liability. What that means is you only have to pay taxes on the profit from that sale. For a mineral rights sale, the capital gain would be determined based on the proceeds from the sale minus the basis assigned to the mineral rights when you purchased the land or inherited the minerals. And Matt, where this becomes really alarming is if you inherited that property and that value was zero, and then you sell that property, the entire sale proceeds would be taxed as capital gains income, which I don't know about you, Matt, but that doesn't sound like any good news to me. And Matt, as we've kind of talked about, determining that step up in cost basis is how you say, okay, this is what the property was worth at the point that I inherited this. And then when you sell the property, you have the value that you sold the property for. The difference of the two is your tax liability. And Matt, I don't think people even realize that there are people like you that do evaluations of the property, and you're really going out and looking at a lot of information to determine what that property might have been worth in the context of selling the property, what it might be worth in the future.
That is a good point. Certainly, if you've inherited property in the last 10 years and it's a substantial size, in other words, the income that you're looking to get from the sales, in the multiple six-figure range or higher, then it's likely that obtaining a professional appraisal to establish a step up in cost basis would be worth the expense. It is not a small expense. I'll be very upfront because it is such a time-consuming process, very technical evaluation, and then the documentation that is required to substantiate the value that's determined is pretty significant. So there's a lot of time and effort that has to go into that report. But again, if you are looking at having to say that the value of those interests was worth zero and you're having to pay thousands of dollars in taxes, then it could be something for sure where, again, depending on the situation and either way, the appraiser or the consultant that you contact should be able to tell you whether it's even worth going down the road of getting the appraisal done, or if it's going to be less from a tax and overall cost perspective just to claim a zero cost basis, unfortunately, and then pay the full sales proceeds as your capital gains income. But, it's, again, something that is worth looking at for sure, because, some clients that I've worked with have inherited property that after the shale revolution, after a lot of horizontal drilling was occurring in the area, in fact, maybe even on their property, to where the value of the asset was pretty substantial when they inherited it. And you may actually not have that significant of a capital gains tax liability if you're in that situation. So it could be a significant tax savings on the other hand. So it really just depends on the situation. It's a very case-by-case specific. But again, it's something to look at if you've inherited property, to be thinking about, is this worth getting a professional appraisal maybe now? So we have this in the back pocket so that if we do decide to sell in the future, we have the cost basis already determined. We know it's very simple then to determine our tax liability from the sale. But again, it's usually when you've decided for sure that you're going to sell. Again, you probably want to hold on to that. Again, talk with your CPA about the particular duration of how long you've had that asset. If it's longer than a year, it falls into typically the long-term capital gains tax rate, which is lower than if you were to just sell it immediately. So there may be some advantages to holding on to the property for at least a year and a day. So definitely talk with your CPA if you're faced with the situation of inheriting mineral interests and you're thinking about selling, because they can advise you on the most tax efficient way to go about that process. So yeah, for sure, something to think about. And then, we've talked about 1031 exchange, which is another thing to think about. You can actually defer the capital gains taxes into the future using a 1031 exchange, which if you were to sell, for example, your mineral or royalty interests, which is a form of real property, you could reinvest that into a rental property, for example, but you have to follow some very specific steps that the IRS code outlines to make sure that you're doing it properly so that you can defer that capital gains tax. Otherwise, you're going to be hit with a tax bill. So we talk about that, and we'll link in the show notes to the episode we did on the 1031 exchanges as well.
Absolutely, man. And again, as we've said, a CPA is really your best friend when it comes to dealing with this information. And somebody who has experience with oil and gas can really help you to narrow down what would be the best option for you. I know it can seem very daunting when you first get into it. There are good people out there. And with the coming changes to estate taxes, Matt, it's something where, involving a CPA as part of your estate planning, if you're going through that, now it could be a good time to do that to make sure that the future is covered in terms of the planning and the changes to the limits.
Yeah, absolutely. And like we were talking before we hit record, we were mentioning some of the trust issues. I know, Justin, you've had to deal with that. And that's kind of outside of the scope of today's episode. And that's certainly something where if you do own minerals and royalties in a trust, there are definitely other considerations to think about. And having a qualified CPA is where you can make sure that you're doing the things you need to be doing as it relates to that. So again, most important thing is having trusted advisors you can call, phone a friend if you get stuck, if you need help on what to do, that you have people that can help with your situation and give you specific advice. Again, this is really intended for educational purposes to arm you with the information, to arm you with enough information to have an informed discussion with your tax advisor and your financial advisor, so you can make sure that you're making the right steps to minimize your tax liability, to ensure that you're making the most of your minerals and royalties. And as always, we will have links to the resources we mentioned in this episode in the show notes, which can be found at mineralrightspodcast.com. So thanks again for listening. And thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.